33 minutes after the hour of 12 noon Central Time, where we are in this hump day edition of the Power Hour. Dave Krieger with you. And Fred Dashevsky, you know what really amazes me, sir, is every time I hear that commercial, there you are. I just said the timing just couldn't be better.
I'm like Beetlejuice. You say my name 3 times and I appear.
There you are. See, it's just amazing. Folks, we got to talk about the economy because that's one of the things that everybody's worried about. That and the southern border, that is killing the Democratic administration here, which it needs to be killed off. These people need to be voted out of office because they're not fiscally responsible. And this is some of the things that we're going to be talking about here as far as the value of the dollar, the economy, and what happens when they keep spending like sailors in a strip club. It's a real problem that we're having right now. And of course, there's some scare tactics out there. I've run across several websites right now that are literally promoting the fact that silver is becoming scarce. Gold's going to go through the roof. Silver, where are we over 30 in silver still, Fred?
Right flat at 30. We actually had the first dip below 30 this week, and I was waiting for that because it had run from about 26 to 32 without a break, and that's a little unnatural. So in all the years I've been watching the prices for the metals, I have noticed they tend to ratchet their way up and then pull back a little and then get a little higher. And, we see those trends, and we'd had this recent run, which was pretty interesting. Broke that $30 mark on silver, hit 32. The same thing with gold. We hit 2,400. It's pulled back a little bit, so we're in the mid 2,300 mark on gold, and right at $30 flat on silver again. So both metals are looking extremely attractive. I've heard a lot about these stories of shortages. In the 40 years I've been doing this, I can't tell you how many times that's come up and turned out to be non-events. Although for periods of time, this is an odd industry because we are dealing in physical products. So every once in a while, we do find it's a little tricky to get particular things that you would not think are hard to find because they're more common. Having dealt with a lot of extremely rare coins that are, honestly one of a kind, I can understand if I can't find one of those. But when it gets to a point where you can't get quantities of generic dimes and quarters and half dollars before 1964, that's a whole different scenario. And it's been a little haphazard, but I would say overall, that's probably more hype than substance.
Yeah, I know. That's why I like my Franklin $50, which I'm holding up on the screen right now. And see, you can tell. Hold on, I'm going to let you listen to it. See, now that doesn't sound like a regular coin hitting the floor, does it?
Yeah, you can ping those if you know how to do that off your thumb. The silver ones will ping. It's like crystal. You actually get a resonance out of it that you don't get from clad, which just thumps. Like if you hit glass, it's the same type of thing. It's actually one of the cheap ways to test whether it's pure silver or pure gold. It'll ping off your finger if it is the pure metal.
Interesting. See, and this is the thing. Thank God we're not sitting here like the farm report, feeder pigs and slaughter steers up a quarter. I mean, see, the thing is those are expendable items. Those literally can die on you. I mean, if something goes around, we're talking about bird flu transmitting to cows. All this, these commodities can go away. These commodities are liquid. These things that I'm holding in my hand right here, these are solid. These have what we call intrinsic value, which is opposed to the dollar bill, which has extrinsic value. And the only reason it does is because we, the people, say it has extrinsic value and we can use it to trade, even though it is a Federal Reserve note. Would that be a fair statement, Fred Dashevsky?
No, that's more than fair. In the end, it comes down to the ultimate user. So if there's an end user, you can have value. And for example, with the US dollar, really the fundamentals come down to the fact that taxpayers know that the Treasury Department, the IRS, will accept payment in the form of these US dollars. So we have an end home for them. And that was actually part of the system built in when the fiat money system was first established. You had to have a way to pull the money back out. Otherwise, you're just printing money into an economy. You need to kind of funnel it back out in the back end. And that was the purpose for income taxes and taxes of those sorts. It's not really because they looked at it as a need for government to add capital and revenue. They needed a funnel to make sure that we didn't overinflate the value of money simply by printing it one way and pumping it into the economy. And, we talk about the inflation rate. It is beginning to slow down a little bit. That's what they like to call disinflation. So inflation's still going up, but going up a little slower. And they're looking at that because, again, everybody's trying to game out the idea of how soon would the Fed begin to lower rates. And here we are, we're in June, and I've held since January we weren't going to see any rate cuts anytime in the first part of the year, and I didn't think we'd see them till third quarter, if at all. And here we are now, we're halfway through the year. I don't think we're any closer to a rate drop than we were in January because inflation remains, the new word now, sticky, and it just simply will not go away.
So, are we looking at stagflation if they don't do something with these interest rates?
Well, stagflation is an economy that's stuck and just stalled, and they're still adding money into the supply. That's a really bad economic environment to have because, like what we were just saying, where you're pulling money back out of the system, if it is a stagflation type of economic environment, you're just not getting the growth in the economy at all to suck up or absorb any of this capital, because you can kind of get rid of some of the printing of money if the economy will expand. And this is the game that they're playing, and it's kind of weird. But, imagine you're dealing with this lever, and you're looking at the way the economy is rolling, and you're saying, okay, if it's not moving fast enough, we have a lever here, and we can adjust that. We'll make money available to the public cheaper, stimulate economic activity, get the economy rolling forward, and, grow the GDP. And if the opposite is true, if it is growing what they would consider too fast and creating too much inflation, well, we can move the lever the other way, raise interest rates, and that will hopefully slow down the economy. And the Fed is now on the tightrope. It's trying to say, well, we think it's time, and the public is sort of leaning toward, we want the lower rate, but the Fed is afraid of looking stupid. They don't want to turn around, drop the rates today, and then a month from now realize that inflation has not gone away, and they have to actually raise rates again to fight it back. So they are struggling with all of the economic data that comes out and trying to find this balance point. I just don't think they're going to come to a significant decision anytime soon.
Well, see, and we had a story on yesterday that was talking about these zero down mortgages. Are you familiar with that?
Yep. Here we go again.
This is scary stuff, folks. This is the stuff that happened in 2003, 2004, and you could go out and you could literally, it got really bad in 2006 and 7, and then 2008, everything started to fall apart. We had the financial collapse. We're already experiencing a restaurant apocalypse because all these restaurants are closing. But the big thing now is they have come out, this particular mortgage company has come out with a way to get a zero down mortgage. And what they do is they will actually finance the down payment. You get up to $15,000. You don't have to pay it back unless you sell the home. However, if the value, because the market is tanking in certain areas, and if you were to take on a loan like this, even though you're making monthly payments, if the value of your house drops and you have to end up paying that $15,000 back, you're stuck in your house and there's no way out of that. You're upside down in your mortgage right out of the gate as soon as it drops. I mean, this is the danger of all this, is it not?
It absolutely is. So if you think about the bank's point of view, if you have let's just say a $500,000 house and they loan you X percent against it, they presume the value of that house is going to remain stable or go up. If it goes down, they have now loaned you money against an asset that's worth less than the original loan, and they may again be forced to adjust or call in the loan or force you to come up with additional money. Do you remember the ninja loans?
Oh, yeah. No job, no income, no assets. So, yeah.
Right? Exactly. So, that exacerbated the problem because effectively they just turned their blind eye to the idea. It didn't matter whether you really were qualified for a loan or not, because the bank writing the loan knew that within 24 hours they could sell the mortgage off to one of the larger institutions that are absorbing all the mortgages, which is how Freddie Mac and Fannie Mae ended up with a huge percentage of all the mortgages owned by Americans are now under their control because of this nonsense that they instituted. The idea was, encourage home ownership. Well, that's all well and good, but you don't want to loan money to people that can't afford to make payments because you're not really helping them. So they move into homes and then they have to move out, or there's foreclosures. And, the real estate market is beginning to slow down a bit because mortgage rates have gone up. We seem to have hit a resistance point at over the 7% mark where, remember, just a couple of years ago, when the mortgage rates were so low, 3.5%, 4%, 30-year money, people were just going crazy, and real estate prices naturally then were on a tear. But now we're beginning to see a little pushback. So we will have resistance as rates go up. And this is part of the problem that the Fed has to deal with. They have to incorporate, how much is the real estate market slowing down? Does that give us room then to not have to raise rates because it's doing the job for us? There are a lot of things involved here that can get complicated for people.
Right. Well, I mean, you've studied psychology, political science, and economics. And I mean, fear, do you think fear right now is driving the markets?
Always is. Fear of loss is actually more of a motivator than gain. And, fear of missing out is another one of these motivational factors that we find. A lot of people just don't know what to make of the current economy because when things break, they seem to happen quickly, but they are ugly. It's not like a minor crack anymore. When things fall apart, they tend to get really ugly really fast and affect a huge number of people. So no one wants to be positioned and realize that they were in one of those areas that was about to implode and should have gotten out. So, for those people that have learned the lessons, I think diversification to me over the 40 years that I've been involved in dealing with things like this has been probably the most successful tool that anybody can utilize because at least it'll even out any potential problems that come up. I know the European Central Bank, for example, is probably close to lowering rates this week, and the Fed is sitting there kind of behind the curve. And we're wondering whether or not we are waiting too long to drop rates because we don't want the public, stalling out in economic growth, especially coming into an election year where, now the Fed has to try to play the game that they're not political. And everybody's trying to say, well, if they time the interest rate drops properly, they could end up definitely influencing the results of an election. So the Fed is kind of watching out for not appearing political and trying to make their judgments based solely on economic numbers. Again, that's a rather tricky tightrope to walk. So we expect an awful lot of volatility going forward. But, look at what's happened to gold and silver just this year. We're still now at about a 30% higher spot price for silver than January 1 and about 15 or 16% on gold. We've actually surpassed what I expected in January to see at some point this year. I think you would ask me just to speculate. And I think silver then was 25, 26. I said we probably should see $30 silver and, $2,300 gold because it was barely over 2,000. And here we are now looking for gold closer to, pushing to 2,400 again. And silver at $30 is rather interesting. I expect a lot more to come.
Oh, wow. So, see, this is the time, folks. If you've got a couple of grand laying around, I realize some of you don't, but if you do, this is the time to think about it. If you can break away, and I don't like telling people to cash in their 401ks or their pensions because if they do that, they get taxed on that.
And penalties.
Yeah, and penalties and everything else. And so that's not a real smart move. But, I mean, if you've got any extra saved up, and you can get a hold of Fred at 800-878-2646 and have a chat with him. And you may have some, I don't like playing the markets anymore. People, if you have the opportunity to get out of the markets, is that a good thing?
Well, I've always been a fan of, like I said, diversifying. So I don't know necessarily that you have to be out of the market, but I need to recommend that you do have protection if you are in it. Because we have to be careful about sudden changes that can be dramatic in those markets that you have no control over. We've seen how quickly it unravels if it does. So I'm looking at the real world and saying, well, if you have a large portfolio, you need to have it in multiple areas for different reasons. You don't churn gold and silver coins quickly. It's not a short-term play. I've never recommended that. I believe it's a long-term process, 5 years or longer. But for those people that like to trade in and out, stocks are much more appropriate for that. And I think it's okay to have some money, in the markets, including the stock market, as long as you have some physical protection. And I do put these things into different categories, and as you kind of pointed out, the single most important thing about gold and silver is its physical nature. It's an actual real thing. You've got your Franklin half dollar. It's a physical item. You can touch it. You can hold it. And again, it will represent true value as other things are subject to much more quick changes in their marketabilities to be turned back into money. And I do wonder whether or not the public is really seeing what's happening out there with clear eyes, or whether they're lulled into the sense of security, by the idea that, oh, this is going up and that's going up, and, we're seeing all this activity. I just, again, have to recommend that people be smart enough to recognize the serious flaws in paper money systems, and it requires a physical hedge.
Well, see, and that's the paper money system because they took us off the gold standard. We no longer can use silver certificates and redeem them for silver. So the bigger thing is it is a fiat currency system, and that people are not aware of this need to, read that Jekyll Island book by G. Edward Griffin. If you don't understand that, or modern money mechanics put out by the Chicago Fed, these are all papers that have been put out that, that's free history for you folks. And this is one of the reasons why we have Fred on the show, because he's been so into the economic cycle of things. He sees all these things. And the beauty about this is, too, because he was talking about trading in and out and thinking you're going to make a profit off this, but there's still this thing to consider. It's called a premium, but the premiums are still low, aren't they?
On the silver coins and the more generic gold coins, it is remarkable to me that the premiums have remained as low and tight to silver and gold prices as they are. And this has been a virtue of a lot of the people taking profit. So what's happened is you had silver that had run so quickly that people who had put a lot of money into it at 25 or 26 were suddenly looking at a $32 price. Well, that afforded them an opportunity to take some money off the table. So you have some people that are trading in and out. Some of the larger investors that do that are not necessarily individuals. There's sometimes the larger hedge funds and things of that nature. And they will buy and sell and, utilize the movement in the market to take advantage of any opportunity to clear a little profit. But with that multitude of sellers taking quick gains, a lot of product moves both forward and backward through the industry. And this is what's kept the premiums tight. It's not going to go on forever, but it is a wonderful opportunity for those that like to accumulate, both because we've had finally this little dip in the silver price and gold price, and because these premiums do remain so low. It's one of the better times to accumulate, even though the price has gone up.
Right. Now, you also, there was news headlines out talking about various countries that are starting to buy up surplus precious metals. Have you gotten the lowdown on that?
It has been huge. Almost every central bank worldwide has been adding to its physical gold reserves at a faster pace than any time in history, and they don't seem to be ending that process. And that tells me certain things. One of them is a lack of confidence in their own currency. And I think that's something we should pay attention to. If they don't feel comfortable enough to keep their own money in their own currency, and they're looking for an alternative, and they're not doing it by buying another currency, which was traditional. Instead, they're taking physical possession of actual gold and silver. I find that rather interesting. And I think the public should follow that line of thinking.
I think they should. It's kind of like warning signs that are, on the wall, but nobody's paying attention, which is one of the reasons why mainstream media will not dwell on this sort of thing. Now, speaking of gold, you acquired some MS-65 St. Gaudens.
Yes, I've been looking carefully for any time I can buy things close to metal value that normally are not. And the spreads between the circulated coins, again, if we look at the scale of coin grading, we go from a 1 to a 70. And the circulated ones, they go up to just under the number of 60. Those are slightly circulated, like a 58 or 55. You go all the way down to like a 25 or a 15, and that's a really worn out coin. But the difference in price between the very lowest and the MS-65 is maybe a couple of $100 right now. It is remarkable, because it used to be $1,000 or $1,500 apart. So this compression, like the accordion squeezed in, that persists currently in the market, has given us an opportunity to offer MS-65 Saints, the St. Gaudens $20 gold coins, and Mint State 65. And these are not just average 65s. These are coins that we hand selected out of the ones already graded to pick the bright, lustrous ones. And they're available at around $3,000 a coin. And if you were just buying a run-of-the-mill circulated 20, they're $2,800. So the difference in money is almost non-existent to be able to move up that high in the grading scale. So I took advantage of that, and I think that's a wonderful opportunity for those that want to add gold.
So is this something that the $3,000 for the price of the coin does not include the premium?
It includes everything.
Oh, wow. Okay.
Delivered, shipped, graded, certified.
Amazing.
No fees for credit card purchases, everything inclusive. And again, I would recommend this to people that are looking to get started, or for those people that are looking to build on their position, because again, I'm convinced that this opportunity where these premiums are so tight can't survive for very long. We're going to look back and just, really be disappointed if we did not take advantage of this.
Well, see, and that's the one thing that is economically driving the fear is fear of loss. And you brought that up earlier on the show because people, you look at what's going on, you see the price of real estate is going up. Some markets right now have actually almost 10% drop in their value. And the thing is that gold and silver, because, like real estate, there is some intrinsic value in the home, and it's called appreciation. But again, if you have a mortgage on the property and you don't have it free and clear, it doesn't have the same kind of factor that this has that I'm holding in my hand right now, which is a $50 that is a pre-1965. In fact,
well, sure, because keep in mind, in real estate, people don't rarely buy the house outright. They usually take a mortgage. So that means that they're buying the money, they're not buying the home, and that's perfectly fine, especially if rates are conducive. But what we're seeing is as the rates go up, it is slowing down that availability for a lot of people to make those mortgage payments work within their framework. So it will create a slowdown in the economy. But look, there are people that are seeing this and recognize what that means. We got away with murder for a couple of years, and look, we spoiled, I think, almost an entire generation of Americans with artificially low interest rates, and that's all they knew. So now they're experiencing something a little normal, and it's shocking to them that looking at a 7.5% mortgage rate instead of 3.5% or 4%. But moving forward, you're going to have people that are going to take an optimistic look at things and a pessimistic look at it, no matter what. I think it was George Bernard Shaw said, you need the optimist because he's the guy that builds the airplane, but you need the pessimist because he's the guy that builds the parachute.
You got to love that. Words of wisdom from Fred Dashevsky. Thanks so much for joining us. We're out of time for this segment. Get a hold of Fred right now, uscoincapital.com, 800-878-2646. Fred, thank you so much for joining us. See you again next time.